The webinar will begin in 1 minute. Welcome, everyone. We are pleased that you have joined us for today's webinar titled The Cost of Insurance Conundrum. The webinar will last approximately 20 minutes, and at the end, you will be given an opportunity to receive supporting materials by email free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter will be Linus Sugis. Linus is the president of Advanced Underwriting Consultants. He and his team answer tax and technical questions posed by producers every day. Linus also spent 14 years working in the home office of a life insurance company in various roles. He also started, ran, and sold an estate planning law practice in the Nashville area. Linus will draw on his legal and life insurance experience during today's webinar, and here he is.
Thank you, Amber. Hello, everyone. Welcome to the seminar today. We're going to spend the next 15 minutes or so talking about the cost of insurance conundrum. You know, I realized when we came up with a title for today's webinar that cost of insurance can mean a lot of things to a lot of different people. We're going to talk very specifically about cost of insurance as it relates to universal life. But before we get into that, let's decide what it is that we're going to talk about next month. Our choices are a case study, business continuation in the Denver Broncos. The second choice is the taxpayer beats the IRS in a split dollar case. And the third choice is Stoli is still dead. Let's go ahead and open the poll and give you the chance to vote, and let's go ahead and start. Cast your vote now. Most everyone's voted. Let's give another couple of seconds for people who haven't to vote. All right, thanks for casting your vote. Next month, we'll discuss the taxpayer beating the IRS in a split dollar case. Thank you for that. So let's go ahead and again, before we get started, the first Wednesday of every month is when we hold our free webinars. Next month's will be on October 5th at 11 a.m. Central, 12 Eastern. You're welcome to attend. You're welcome to view the recording on our YouTube channel afterwards, and you're welcome to invite guests. This is free and available to everyone. So thanks for that. Let's go ahead and get started on the cost of insurance conundrum. I think in order to understand what the conundrum is, it's important to review how universal life works, at least a little bit. And we pulled this picture from the website that's cited on the PowerPoint. But universal life has a pot of cash value in it. And that cash value's initial growth is due to premium deposits from the policy owner. Those deposits are accumulated inside of the cash value, and the insurance company credits interest one way or another to that pot. It might be tied to some equity standard, or it might just be a declared interest rate. For variable universal life, it might be tied to a fund of a product family, a fund family. but the insurance company credits interest based on some factor or another, and that's what helps the cash value to grow over time. Now, the policy owner doesn't have it all her or his way. The insurance company leaks certain things from that cash value. One possibility is that there is a premium load. Not every product has a load on their premium, but may be a percentage of premium that the insurance company collects that is paid out of the contract's cash value. There may be monthly administrative fees that are also drawn from the policy's cash value and paid to the insurance company. The thing we're going to talk specifically about today is the cost of insurance. The insurance company collects, usually monthly, a fee for the cost of insurance associated with the universal life policy. More on that as we work our way through today's webinar. So what is the cost of insurance? Well, let's say that we've got a $500,000 face amount universal life policy, and the universal life policy grows its cash value over time. Well, the difference between the cash value and the $500,000 death benefit is the amount at risk. The term amount at risk refers to the insurance company's amount that it has at risk. It's already obligated to pay back the cash value to the policy owner in the event of surrender. But in the event the insured dies, there is an extra amount the insurance company is going to have to pay out, and that's the amount that it has at risk. And so that's why it's referred to, I think, as the amount at risk. And in this example, we're assuming a level death benefit policy at a $500,000 and modest cash value growth on the contract. So there's a significant amount at risk in the policy. And again, the amount at risk is the difference between the cash value and the death benefit. Now, the insurance company, as we saw in the prior diagram, charges an amount each month for the amount at risk. It's the amount at risk is the equivalent of a term insurance policy. It's kind of a decreasing benefit term insurance policy. And the insurance company generally charges a rate per $1,000 of amount at risk every month to cover the cost of the insurance company covering the risk. And that amount is lower when the policy has just been issued and the insured is presumably in good shape. And it gets bigger, the rate per $1,000 of amount at risk coverage gets bigger over time. And in a perfect world with a well-performing universal life contract, the cash value will grow over time. The amount at risk on a level death benefit product will get smaller and smaller. And so while the insured's rate for the term portion, the amount at risk portion of the coverage will go up, the rate will go up, the actual amount at risk will go down because the difference between the cash value and the policy's death benefit gets smaller in a well-performing universal life policy over time. Well, what happens if it doesn't get smaller? Well, the answer is, in the absence of any kind of product features that would say otherwise, the cost of insurance gets to be a bigger drag on the product's performance, and the likelihood of the policy lapsing gets much bigger because the cost of insurance goes up over time, frustrating the performance of the product. And so the interest rate that's credited and the premiums that are paid aren't enough to make the product work and perform very well. So the amount at risk ends up being a big factor in the overall product performance. The cost of insurance associated with the amount at risk also ends up being a big factor in the policy's performance. Now, to make matters even more complicated, the insurance company publishes cost of insurance factors for the amount at risk based on their current assumptions when they sell a new policy. But they have the right, the insurance company has the right to raise the monthly price that they charge for the pure insurance element if they decide that they need to. And so there is a current cost of insurance and there is a guaranteed cost of insurance. Now, the good thing about the guaranteed is that that monthly cost of insurance rate is the maximum the insurance company can charge. The bad news is that that rate is substantially higher than the current rate, and it can play a significant role on the overall performance of a universal life product. Let's take a look at a sample universal life ledger to talk a little bit more about how this might work. So this is a pure sample of a universal life ledger, and it's just one page. Any of you who work with universal life or any interest-sensitive product, you know that it's not unusual to have a 20-page illustration. This is just the part that's kind of relevant for somebody to look at. You know, in this particular sample illustration, we're seeing that there's cash value element and a death benefit element. And this particular illustration is like the second or third page of projected values based on the 5.42% assumed credited rate and current charges. You know, universal life is really designed to be flexible. It's also designed for an informed consumer to understand all of what's going on. And the overall intent of universal life has been to make buying insurance easier for the layperson to understand. Unfortunately, it's had, at best, it's had a neutral effect, and at worst, it's perhaps had the opposite effect. On this ledger, somebody running an illustration will usually choose the current credited interest rate for the policy performance, right? Whatever interest rate the insurance company is crediting. What they usually don't have the right to do is to change the cost of insurance charges from the current rates to the guaranteed rates, or to a different rate that might be between the current rate and the guaranteed rate. That's not to say that there isn't a place on the illustration where guaranteed cost of insurance rates don't appear, right? They do appear on the illustration, but they're mashed together with the guaranteed interest rate and guaranteed cost of insurance rates on the columns that are always troubling to explain to a client, where the coverage lapses prior to the end, right? So the client doesn't get a clear picture of how a change in cost of insurance rates will affect the policy's performance. Usually the only thing the agent has the power to change at will is the credited interest rate. And so that can potentially present a problem for clients. And that's really what we're talking about today. We're going to talk about Equitable and its cost of insurance litigation that is happening or has been happening in federal court. So the carrier, in this case, Equitable, raised its cost of insurance rates for part of its portfolio, and the policy owners were ticked off by that, and so they filed a class action lawsuit. And what they said is that they were misled by the policy illustration and misled by the idea that about how the policy would perform over time. They didn't realize that AXA Equitable had the freedom to change the cost of insurance charges. And the carrier responded as it would typically in this kind of lawsuit by saying, tough, look, our contract says we have the ability to raise the cost of insurance rates. We can raise them as high as the guaranteed rates. And so even though this may have been unexpected to some of you policy owners, you should have read the policy and should have been aware that we had the power to do this. And so the carrier asked the court to dismiss the lawsuit. And so the court, in evaluating this, looked at the policy language and pulled particular language about reasonable assumptions here in this excerpt. You can see that the language says cost of insurance will be based on reasonable assumptions as to expenses, mortality, policy and contract claims, taxes, investment income, and lapses. And the carriers in this type of litigation have consistently maintained that these are the kinds of things that could cause a change in cost of insurance. And some courts have held that because the carrier drafts the contract, these are the only things that a carrier can consider in changing cost of insurance. The carrier cannot change cost of insurance just to potentially increase profit, for example. That's what some other courts have held. And so this court decided that while the carrier had the power to change cost of insurance, it didn't know yet whether or not its change of cost of insurance charges for this contract was consistent with the assumptions that are reasonable based on the carrier's own language in the insurance contract. And so it's too soon to dismiss the lawsuit. There is no final result yet, and the case is ongoing. And we'll either find out how the court ultimately rules at the end, or the case will be settled before the end. We don't know how that'll turn out, but the case is ongoing, which makes it more expensive from a carrier's perspective. So what are the takeaways from this case, even though it's not finished? I think the first takeaway is that cost of insurance is hard to understand, but we have to do our best. If we're life insurance professionals, we have to try to explain to our clients how cost of insurance works and how it might affect overall policy performance, even if we don't have the ability to illustrate it perfectly in a policy illustration. Certainly ledger style illustrations are not perfect. You saw the one pager as part of this PowerPoint. It's not unusual to have 20 pagers these days where you have to sift through the information on the ledger to try to explain things to a client. And the federal government, when it gets involved in these things to try to help explain things to client, adds more pages to what's already there, making it even harder for people to understand. And so the agent has to fill the gap. Explaining how universal life works is hard. You can see how difficult a time even I had doing it, and I've been trying to explain it for 35 years. Explaining it to a client in a way the client understands is hard work. And so explaining how a COI change, a cost of insurance change, might end up affecting somebody, it's really hard. Trying to anticipate what the client's expectations might be with regard to their policy's performance is really hard. I don't have any great answers, and so therefore we named today's webinar the Cost of Insurance Conundrum. Explaining is hard, and the only takeaway I suppose I can give you here is do your best and keep these kinds of pieces of information in mind, recognizing that clients are lay people and may not understand anything about what you're saying, or certainly won't understand fully about what you're saying. But you'll do your best at the front end, and you'll do your best to explain how their policies are working in force as things go along, and that will minimize the chances of your client being ticked off with you. Thanks for being part of today's webinar. I'm going to turn the program back over to Amber to wrap us up. Amber?
Thank you for joining us today. As a reminder, if you would like to receive supporting materials, feel welcome to email us at asktheexpert@advancedunderwriting.com. You may also email questions related to today's webinar. Feel welcome to join us for the next webinar on the first Wednesday of next month, October 5th at this same time. Next month's webinar will be titled Taxpayer Beats IRS in Split Dollar Case. You can also find an archive of past webinars on our YouTube channel, Advanced Underwriting Consultants. Please subscribe to our channel. It helps us to keep making free webinar content. Today's presentation will be posted on our YouTube channel by the end of this week. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact us at 615-224-1291. That's 615-224-1291. Thanks again and best wishes for continued success.